Hi, Tasty Nation. This is the Canadian Options Trader. I'm going to go through a trade that I came up with called the 111 or the 111 put trade. This trade is based loosely on Uncle Tony's 441 trade, and I'm going to put a link to that trade in the show notes. This is a trade that I like to put on a down day when volatility is expanded. I know this is not much of a down day today, but we're down about 5 points right now on the MES. I like to do this trade in /MES, which is the S&P 500 micro future, equivalent to 50 shares of SPY. I start at around the 25 delta and I buy a put. Then I go 50 points wide and sell a put. Expand this. So I'm buying a put spread, 50 points wide. That put spread is trading for mid-price around 7 points right now, and I will now adjust it to try and get 10 points. So I'm going closer to the money. MES is trading at 38.98 right now. Okay, so this is trading for around 10. Margin impact is very, very low because it's just a put spread. Now, to finance that 10-point put spread, I want to sell a put. So I'm going to go way down out of the money and look for something that's selling for around 20 points. Okay, so maybe the 33.70 put, it's at the 9 delta. So this is a very low risk trade. Using the regular Tasty Trade mechanics, this is in the 48-day cycle. There's only a 10% chance that /MES will get down to 33.70 by expiration. And in that event, I would have to be okay at either accepting delivery of a long contract of /MES or just keep rolling that put down and out as you would for any short put. So a total credit of around 10 points, which when you multiply by the multiplier for MES is 5, that's $50. So in this case, I'm collecting actually $58 and probability of profit is 99%. This is a very, very high probability trade, but I'm only getting $58 credit. Look at my break even. Even though the short put is at 33.70, the 9 delta, my break even is at 33.09. It's another 60 points below my short put. So this is the great thing about the 111. It has a very low break even. If the market keeps going higher, I'm not going to lose anything on this trade. It's technically a slightly bullish trade, but if the market goes down just a little bit, I can make max profit at expiration. So I wouldn't do this unless I was comfortable going long 50 shares of SPY or one MES contract at 33.70. Look at the margin I'm using on this, $82. This is the power of futures and micro futures. I love micro futures and I love micro futures options. /MES, love this product. Okay, here's the other thing I'm going to do. This came from Uncle Tony as well. Uncle Tony talked about his 441 trade on the Liz and Jenny show that I appeared on with him. I'll put the link to that in the show notes as well. I'm going to do 2 units of this. Okay, so now I'm collecting $117 credit. 2 units. So I'm buying 2, selling 2, selling 2. So I'm doing a 222. Okay, I'm going to transmit that order. Then when I get filled on that, I will put in an order to buy back those 2 puts and sell a higher put, reducing my unit exposure. So rather than having 2 naked puts over the course of this trade, as volatility goes down, I'm going to reduce my units by going from 2 naked puts down to 1 naked put, which is half the risk. And I still have that long put spread protecting me. So this is called the 111 put trade, or the 222, converting it into a 221. Okay, so this is later that same day. This is in the evening when the futures markets are open, but the equity markets are closed. I got filled on that order. It's showing up here as a combo. I'm long 2 units of this combo. If I expand it out, you can see I'm long 2 of the 3750 puts. I'm short 2 of the 3700 puts. And then further out of the money, I'm short 2 naked puts at 3370. Okay, so if I look at the options chain here, you can just barely see all my strikes on the same page at the same time. There's my 2 naked puts there. So I'm going to turn on Strategy Builder, and I'm going to put in an order to buy back those 2 puts. I'll try and sell a closer to the money put, maybe 3,500. The strike doesn't really matter. So I want to buy back 2 and sell 1 to reduce my unit risk. And I'll try and do that for a credit, okay? And it's not really affecting my margin, but I know it's affecting my unit risk. So it just makes me feel better, sleep better at night, having less unit risk. So tiny credit. When this order gets filled, it's going to split up this combo. So why do I do a 111 instead of a 441? And why do I do a 222 instead of an 882? It's because the way I do it, there's less units here, less commission costs, and when that order fills, it'll break up this combo and it can become a jumbled mess of all the different MES options I have on. With less units, it's less mess for me to look at, but also less contracts is less commissions. So I'm concerned about commissions. And with the 111, my naked short put is much further out of the money than with a 442. Thank you, Uncle Tony, for teaching us this concept of having some downside protection and also losing nothing if the market keeps going higher. So this is a very slightly bullish trade. How do I manage these trades other than converting that 2 naked puts to 1 naked put? The other thing I do is I just hold them till expiration, because I don't care if I get assigned on that MES. And if the market does go down, I can always roll that put out in time and collect a credit on it. Even if I still have 2 puts at the time, I can still roll those out without any trouble. Okay, thanks for watching.